The world runs on money. Even when we say money can't buy happiness, deep inside, one way or the other, most of us want to be rich. Would you like to know some simple rules for that? Stay tuned to learn how to easily gain wealth and live the life of your dreams. When talking about investment, majority have a lower success rate than that, and fewer people turn into a millionaire. It's because they understand some rules that everyone else never gets. If you want to know these rules, stay tuned with us till the end. But at the end of this video, you'll learn some amazing tricks. The good news is that the fundamental principles of money are not difficult to grasp. They've been the same for hundreds of years. You can develop money beyond your wildest dreams if you grasp and master the fundamental rules. Number 1. Intelligence and integrity are the foundations. Financial integrity should be the foundation of a long-term relationship between a company and its customers. Everyone wants to believe that a firm will protect its interest if they commit to them. But how many organizations can keep their promises? Although we hear the word frequently in professional and personal contexts, its meaning can be difficult to summarize. Integrity is described as a consistent demonstration of moral views and ideals. It matches your personal or professional behavior with what you believe to be right and ethical, regardless of the circumstances. Number 2. Invest by facts, not emotions. There's no getting around it. Investing is an emotional endeavor. After all, your money and your financial future are at stake. However, controlling your emotions and staying focused on a plan tailored to your goals and risk tolerance might be critical to your long-term investment success. Surely, you can connect to this graphic of a roller coaster. How many of these emotions have you experienced as an investor? Going through this emotional cycle is quite normal. The problem is determining how to react to market peaks and valleys, especially when the market declines significantly. Think about the following. When the markets rise and life is good, you may wonder, should I invest more? As a result, considering the opposite possibility is equally beneficial. When markets are in the capitulation stage, you may wonder, should I reduce my losses and sell? It's human nature to want to act, but if you sell, you'll confront a very different reality when markets rebound. And when optimism, then euphoria returns. In summary, you risk missing out on the market's comeback and favorable gains by exiting the market. Number 3. Buy wonderful businesses, not cigarette butts. This is said by Warren Buffett, the guy who gave the best advice when it comes to investment. He said this important thing to be noticed while buying. It's far better to buy a fantastic firm at a reasonable price than a fantastic company at a reasonable price. It is analogous to buying an extremely cheap, seemingly worthless stock that no one is willing to buy and then squeezing gains from it. This is also known as penny stock investing. The premise is that equities that have fallen to very low prices, pennies in the United States, can sometimes surge on a silver of good news. In percentage terms, this surge is larger for rupee stocks than for a higher valued company in the same situation. Number 4. Buy only stocks that you understand. You might opt to invest in a particular company for countless reasons, but according to Berkshire Hathaway CEO Warren Buffett, there is one you should never do. Buy a stock only because you believe its price will rise. This is because even the best investors cannot forecast how the market will behave. According to Buffett, you should instead invest in companies you understand and believe will provide long-term value. Buffett believes that everyone who buys a stock should be able to take a yellow pad and write down exactly why they intend to invest in that particular company. He also believes that investors need not be concerned about how the stock will do in the short term. If you want to forecast the stock price, you can have a different piece of paper, he stated. Rather, Buffett advises investing in companies that will retain their worth over time. Nobody buys a farm depending on whether they think it's going to rain next year, he told CNBC in 2018. Buffett follows 3 fundamental rules when determining which firms to invest in. First, they must make good returns on the net tangible capital required in their operation. Second, they must be managed by capable and trustworthy individuals. Finally, they must be affordable, he stated in his 2019 annual letter to Berkshire shareholders. However, any stock might outperform or underperform, and previous performances does not guarantee future outcomes. Instead, novice investors can use low-cost index funds, which are much less hazardous. Number 5. Seize the opportunity. When an opportunity is in front of you, never let them go off your hands. The biggest hazard in time of turmoil is to behave with yesterday's wise reasoning, stated Peter Drucker, widely regarded as the father of contemporary management. The cash flow consequences of seizing opportunities, entrepreneurs and small business owners must frequently act swiftly to seize an opportunity before it passes them by. The problem is that even though the margin and prospective profit all make good economic sense, taking on the opportunity without fully comprehending the cash implications could put your entire organization at risk. We're not suggesting you shouldn't act swiftly, but it's critical to comprehend the financial implications of every decision, no matter how profitable you believe it is. There is much we cannot change in the existing situation, much that is beyond our control. But one thing we can control is where we direct our attention and energy. And as the saying goes, where focus goes, energy flows. That is, if you focus on difficulties, guess what happens? These issues will exacerbate. However, if you concentrate on solutions, those solutions will grow. So what should you do now if you're dealing with financial insecurity and thinking about making new investments, such as commercial real estate syndications? Begin by identifying the issues that are impeding your progress. Then, concentrate on educating yourself and brainstorming potential answers. Number 6. Don't sell because of price fluctuations. Your stock is depreciating. You want to sell, but you can't decide whether to sell now, before additional losses, or later when losses may or may not be worse. All you know is that you wish to liquidate your share while retaining your capital and reinvesting the proceeds in the more profitable security. In an ideal world, you would always attain this goal and sell at the appropriate time. Unfortunately, it's not that simple in real life. Investors froze as the housing bubble burst in 2007, and stocks began their decline into bear market. Many did not respond until their portfolio holdings value had dropped by 50 to 60%. One thing all championship teams have in common is a strong defense. This theory also applies to the stock market. You cannot win unless you have a predefined defense strategy to limit your losses. A defensive plan or exit strategy in place before entering a deal protects against emotional trading. We tend to let emotions like greed or fear take over and cloud our judgment. The traditional stock investing maxim is seeking high-quality companies at reasonable prices. Following this principle explains why there are no straightforward rules for selling and purchasing. It rarely comes down to something as simple as price change. Investors must also analyze the company's qualities. On the fundamental analytical side, there are many distinct sorts of investors, such as value or growth. Number 7. Buy stocks below what they are worth. Warren Buffett's relevant observation on stocks. He regards buying a stock as buying a business and wants to buy future regular cash flows at a discount. He wants the organization to have high-quality management and a competitive advantage that is difficult to duplicate. He desires a business with a high barrier to entry for new competitors. A company's ability to maintain and expand earnings and dividends without the use of debt. Corporation that has monopoly on a particular technology, business model, or brand strength. Pricing power that can keep pace with inflation. Buying at a price below inherent value necessities, some basic analytical skills. If you completely knew a business and its future, you would require very little in the way of a margin of safety. So, presuming you still wish to invest in the business, the higher the margin of safety you would require. Buffett Warren. For example, suppose a business stock was trading at $20, and an analyst determined that it should be worth $24 after conducting comprehensive research on the company. Another analyst conducts a comparative study and concludes it is worth $26. Many investors would take the average of these estimates and conclude that the stock's intrinsic value is likely about $25. Often investors regard these assessments as extremely important because they wish to buy equities trading at considerably lower prices than their intrinsic values. It leads to a third significant fundamental analysis assumption. The stock market will eventually reflect the fundamentals. The issue is that no one knows how long the long run is. It could be a matter of days or years. It is the essence of fundamental analysis. An investor can evaluate a firm's intrinsic worth and uncover opportunities to acquire at a discount or sell at a premium by focusing on a specific business. The investment will pay off when the market catches up to the fundamentals. We're sure you guys have some amazing ideas for this year.